All right, this is what we're going to break down over the next several minutes. It's going to be a lot, but I encourage you to focus really on the fundamentals and the concepts overall. So for now, just hear, watch, and listen. And we'll go through each metric and some of the formulas. But again, just looking at it as a high level so you pull the concepts out. This is what we're going to go through. This scorecard here, which is the ultimate D2C e-commerce scorecard for running your business. Obviously, you want to know all the typical financial metrics in your business, balance sheet, P&L, inside and out. However, I argue that in addition to those, this should really be your daily, weekly, monthly driver in terms of growing, scaling, and understanding your D2C business and how it really runs. I've worked with and seen so many owners that obviously understand all the elements of their P&L, but really not the fundamentals of the leverage points of how their e-commerce business is really growing, or the opposite of growing. At the end of the day, you can understand your revenue, cost, profit, but if you don't understand how those customers are coming in, why, at what rate, how they're retaining, what the efficiency is of the acquisition, and how that relates to your key business metrics, all of which we'll go through here. If you don't understand that, then you fundamentally don't understand how to really change the P&L to go the way that you want it to go. So this is a deeper look into your D2C business, but it's also high level enough so that you have a roll up into what matters most so that you can make the most important decisions for your business. As we go through this, in your head, you'll ask things like, hey, what should this rate be? What should my blended ROAS be? What very specific metric do I attack? And to a certain extent, some of those benchmarks are relevant and some of them aren't, meaning your business is unique. Your goals are unique. Your exit plan, your timeline, your appetite for investment, all those are unique based on you and what you want out of your business and what your overall business goals are. So therefore, your KPIs and benchmarks are going to be different. So it's really important to understand what they are, the fundamentals, how they relate, and then laying that on top of your other business financials to find what benchmarks really work for you. We'll look at profitability, which is obviously key to your business, in addition to serving your customers and making the best products. So we're going to stick to the fundamentals here and the must know KPIs for your e-commerce business. So that way you have the tools necessary to influence the business in the way that you want to. Okay, so we will start by looking at each of the definitions here at a high level. Then we'll break it back out and talk about how they relate to each other. Use this example here to show trends and pull different things out of what this hypothetical situation, if these were your numbers, what maybe you should do different, what maybe your marketing team should do different based on the information we see here. Okay, so as not to distract, let's close all the months for now and just look at the total. And again, just go over the definitions here from a high level. I like to include other channels, any other online channels that are driving revenue for the business, to see kind of the all up online numbers. So this for you, could be any other source, whether it's Target Plus, Amazon, etc. So that's good to know from a high level perspective as you are looking at investments into the business. But for now, we'll hide that and just look at .com revenue, which is the focus here. This is pretty simple. It's just your online revenue, which is a makeup from your P&L, product revenue, shipping revenue, discounts. You may have some unique line items there, but whatever the case, it's just a roll up of your revenue. So to keep things simple, we won't be looking at these items here today, although it's very important, which is why they're here to look at your discounts as a percentage of revenue, your shipping as a percentage of revenue, whether or not you may be leaving things on the table in terms of obtaining additional shipping revenue from your checkout. But again, we'll leave that for later. Most importantly here, in terms of on the opposite side of the revenue, your COGS, which is just a roll up of your hard product COGS, but also merchant account fees, shipping, delivery, any other variable COGS rolling up to your total COGS. Again, this is a little bit unique to each business in the way that this is broken out in the chart of accounts, but everyone is familiar with the COGS there. So again, we'll just hide that for now. I like to look at COGS as a percentage of of revenue instead of the other way around, just because it's a lot more simple to look at it as what is the cost relative to my revenue, and how's that trending over time. Obviously this should be, somewhat steady, but it will change over time. And if we're looking at, especially over multiple quarters, or if the fundamentals of the revenue and our other metrics are changing, especially profitability, we need to make sure that this isn't the variable that's causing the delta there. Okay, getting into some of the specifics and core of this here, still under business metrics, but ROI, e-com gross profit, MER, CAC, these are all heavy online metrics, but they are super key and one of your top business metrics, or they should be. So the definitions that we're using here for ROI: all marketing revenue minus your discounts, of course, divided by all marketing spend, including, here we're including agency fees and services. So for you, that may be your internal marketing team, it may be an agency, it may be a blend of both. But again, all marketing spend, so advertising, marketing, hard costs. So that's a total return on investment of the revenue over those costs. In this case, a 6.3x. E-com gross profit. This is one that we're adding here that we advocate for, which is basically just your revenue minus your COGS, so and variable fees. So a normal gross profit number, except we're also building in the cost of advertising. So not agency fees, not your contractors or your full-time marketing team, but just your pure variable costs of advertising and your variable COGS. So e-com gross profit, this is really important for at a glance to say, after my hard costs and my biggest marketing efforts that are the most variable and influential, which is generally your media spend, what am I left with at the end of the day to use for the rest of the business? MER, also known as, let's go over here to the definitions: media efficiency ratio, marketing efficiency ratio. This has a bunch of different names. A lot of companies and agencies use this in different ways, but in the simplest form, it's all online revenue over all media spend. So what did you make in revenue that month, divided by however much you spent on Google, Meta, TikTok, etc. So this is really an efficiency ratio that is important. It only goes so deep in telling you what's going on, but it's an important benchmark to look at as compared to the rest of your financial metrics. We'll come back to that. CAC, so customer acquisition cost. Again, you'll see different acronyms for this, but basically, what does it cost for you to acquire a customer? So this is your media spend divided by however many net new customers you acquired in that period. So here we're saying in total for the year, we acquired 26,000 customers. We spent $815,000 to acquire new customers. Therefore, we end up with a customer acquisition cost of $31 per customer. Profit, self-explanatory. This should come directly from your P&L or a kind of a set fixed cost minus your e-com gross profit. But obviously, if we can get the real profit number from the P&L, that'll be really important here. Okay, marketing metrics. So in addition to these here, media spend, again, likely a huge number for every e-commerce business. The biggest variable and discretionary part of not just your marketing budget, but probably the budget in the entire company. So it's really important to know that, to see it right there as compared to the rest of your financial metrics. Blended ROAS. ROAS is return on advertising spend. So going back here to the definition, blended return on ad spend is basically all your media channels, all of your advertising spend over what divided by the revenue that has come in from that. So this measures the overall effectiveness of your media campaigns. It is really important to dial the attribution and look back period. If I'm losing you there, you can look at this later, but basically you can ensure that, say you're looking at Google and Meta, to dial those attribution metrics in for both how far we're looking back and what kind of attribution are we looking at, view through or click through. With Google and Facebook in particular, you can have those be very similar in nature or as similar as you can make them to make sure that our blended ROAS is really that we're comparing apples to apples. But again, this is a high level, the best that you can get from your in-platform advertising mediums and looking at it relative to the rest of the metrics here. We also like to ensure that we have a break-even ROAS, right? Doing the math on, in general, if we hit this as a return on advertising spend, if we hit 3.0 or 300%, so if we spend 100,000 in advertising and we get 300,000 in return, then we know that this generally results in X amount of a gross margin and profitability for a business that is acceptable. Again, that's going to vary, and we'll look at that. CAC, we already took a look at, but really important here is again, break-even CAC. So just like to list the benchmarks here. Obviously, this spreadsheet does not have goals for any of these. That's a different format once you understand these metrics here and you have them goaled out. But we do like to, right in line with the actuals, ensure that we have at least a break-even number. Again, all other things being similar, we know that if we can acquire customers at $37 a customer or under, that we're going to be profitable or hitting whatever other goals, financial goals we've set for the business. Okay, lastly here, customer metrics. This is one that is just massively underused or not even understood. I've worked with so many businesses that they're running even if it's a $30 million D2C business. I mean, they know that they're obsessed with metrics like, ROAS or ROI or sometimes even CAC, but usually I find a strange obsession around something like ROAS. They don't know how many new customers they're bringing in. They know the revenue, they know the profit, they know some other random marketing metrics, but they don't understand, are they acquiring new customers at a greater rate than they were the previous quarter or the previous year, and how new customers are building their revenue versus just monetizing, also known as exhausting the existing customers and existing database. So how many new customers are we bringing in, and what is the new revenue from those customers? And then finally, the acquisition marketing efficiency ratio for new customers. So let's go back here. Basically, a fancy way of saying how much is what our efficiency ratio is for our new customer revenue over our total ad spend. So this shows how much coverage the new customer revenue by itself is providing across all of the media spend. So we know that going back here, we see new customer revenue of 2.4 million. We've spent 800K in media. We know alone that just by itself, our new customer revenue is covering our media spend to the tune of 3x, right? We obviously have more revenue being driven from this media spend because you're bringing back existing customers, you're retargeting existing customers, you're upselling, etc. So there's more revenue coming from this media spend, but it's important to know how many new customers only are we bringing in each month, and what is the resulting revenue from that. And this is your efficiency ratio there. Lastly here, retention revenue and retention revenue percentage. So really this is simply just a function of what is our revenue that we've brought in for the year or the month in total minus our new customer revenue. So any revenue that's left over after your new customer revenue is retention revenue, meaning it's coming from your customers, your existing database. You already have those customers. They're coming back and producing the rest of that revenue for you. So our retention revenue percentage is 54%, right? So 54% of our revenue in the month or the year is coming from existing customers. So now we know that 46% is coming from new customers. Again, by itself, this is helpful, but what's really helpful is trending it out over time, over months, over quarters, relative to other metrics to help you understand, again, if you're exhausting the database. A lot of times you can have false positives here where, oh, we had a great month, but you look down here and we've increased by 10 or 20% our retention revenue. So yeah, we had a great month, but it looks like someone just pumped the database, which can be fine. It doesn't always have to be a negative. It could be a big promotion or a new product release, but it's really important to know how much your new customers are contributing to your revenue versus your existing customers, and keeping that in balance as well. Okay, let's expand this out, look at it by monthly trends, and see if we can't make some actionable decisions for our business, or at least understanding some of the core metrics and what we can do to adjust in the following season, following year, create our goals, etc. So starting out here with a January, February comparison, because there's a big variance in these months, and we see some kind of tipping points in some of these metrics. The thing that jumps out right away is your ROI, right? ROI going from 4 to 3, a bit of a jump in the month. Our gross profits jumped as well. Obviously, our all up revenue did as expected, especially in a short month. Our marketing efficiency ratio dropped. Our CAC actually went up. And all these things resulted in a loss in February. But sticking to January for a second, this looks pretty normal, right? Because we can see for the year, we're at a 6.6. January was dead on with that. Our average CAC is 31. January, we were 33. We actually had a pretty good profit for January. Our media spend was kind of in line with averages. Our blended ROAS is where we want it to be or above, or perhaps it was too high. We'll come back to that in a second. And we already took a look at our CAC. So that is a good month, relatively speaking, from a profitability standpoint, but it also depends on your customer goals. So as compared to February, where we saw our marketing metrics, efficiency metrics drop, right? We saw CAC increase specifically with our spending increase and our efficiency of that spend going down, right? So that was really the biggest thing here. We continued to push spending. Spending went up month over month, but revenue went down. Spending went up, but new customers did go up. However, again, all up, we still didn't collect as much revenue. We see here that our retention revenue was low, right? So you can start to see how all these numbers really play strongly into each other. This is why it's important to have all of these stacked and looking at them together, because anyone could come to you and say, hey, look, we got another 100, 200 customers in the month. Great. That was a great month. But what about everything else? Right? That actually is really good. But what is our profitability goal? Were we okay with losing, $3,000 to increase our number of customers? Maybe you were. But you could also look at this and say, like, our retention revenue was low, the lowest of the year, in fact. So that probably tells me we under leveraged our databases, our cross sell, our workflow automations, etc. Like, why was our ratio so low? Could we not have kept increasing the new customers, but also even increased more revenue from our database, which maybe would have covered our profit our loss here and put us into profitability while also increasing new customers. So you don't immediately want to make the decision, let's pull back on media spend because we lost money in February. When in reality, you increased your media spend, you gain more customers. Your efficiency was close to where you wanted it to be, but perhaps the drop came more from the database, right? So you don't want to necessarily overreact to some of these numbers. Now, let's look at that a little bit closer. We're really close to our blended ROAS, and we are actually, while our CAC did go up, we're still under our goal. So arguably, this could be a model month from a marketing, a new customer acquisition efficiency perspective. If, and this is the key part here that you need to understand for your business, if you're in growth mode, if you're in new customer acquisition mode, there's a big difference between I want to grow revenue and I want to be profitable versus I want to attack and I want to gain market share, and top line revenue is most important. Maybe I'm okay with a break even or a 5% profitability, right? This year over here, we had a 10% profitability if you added in the other channels that we hit up here. So it just depends on your goals. This is the biggest mistake I see as well, in terms of just really not understanding that while you can have a good revenue month and a profit month, it doesn't necessarily mean you're growing from a long-term viability perspective. If you're not growing your net new customers, you're going backwards at some point, unless you have an insane retention rate and you're able to get more and more incremental revenue from your customers, above a 50, 60, 70% clip. Really, there's no way to slice it. If you want to grow long term, you have to be incrementally growing your customer base. So from an aggressive standpoint, a growth standpoint, I don't mind this potentially for this hypothetical customer. What I would look at is, did we miss somewhere else? And let's make sure that we don't overreact or overcorrect on spending just because we had one break even month where we start going backwards on new customer acquisition. Luckily here in this example, went ahead and kept pushing on media spend, acquired more customers, and benefited from that. Here's an example where your hypothetical break-even ROAS, we're under that, but we're meaning we're above target, which could potentially be a negative, but we're actually within target on CAC, and the business was profitable in the month, and we gained more customers. Again, another example of why it's important to look at all of these metrics together and not just one single metric, and making poor decisions based on that without looking at what the real influence is on the business as a whole. Skipping ahead to a couple other examples of why and where this data is so powerful. Looking at our biggest point in the year, of course, outside from November, from a new customer acquisition standpoint, almost 3,000 customers against, an average of 2,200 customers a month. May was able to generate 500 more additional customers above the average. And really, if you exclude November, we'll say the average was 2,000, is about 2,000 or 2,100 customers a month. So we're able to get 600 additional customers in May. So let's see how we did that. Increased media spend by roughly 30% and maintained ROAS and went slightly above our CAC goal, but the business was profitable. That incremental spend resulted in enough incremental revenue and incremental customers to still make the business profitable. There were probably some other areas there that potentially helped the business, including maybe some big promos from the database down here. But overall, what we say on the marketing side is we scaled well, right? We pushed spend up, we were more aggressive, and we were paid for our results, not just in top line revenue, but it was also profitable as well. All right, so let's look at potential bad example. Again, depends on from a marketer and a growth mindset standpoint, a bad example. But you as a business owner, maybe you're good with this, and again that's fine. But let's look at this example here for November, which obviously is the biggest month of the year for most all businesses. We see, of course, grew revenue exponentially, 800K. We were very profitable, so made roughly 20% of the profit in 1 month. This is great. Our media spend was 67,000, which is up from October and up from December, resulting in a really great blended ROAS of 5x, right? And we brought our CAC down all the way to 20. This is exactly what some people, some owners want to hear. We grew revenue, we were profitable, more revenue, and our ROAS was huge, right? We got a 5x, even though we spent a large amount on our advertising. Generally, this isn't good unless you are intently focused on incremental profit, and November needs to be a profitable year and the rest of the year was bad from a profit standpoint, then this is understandable. However, in this case, looking at this as a whole, what I would say is we left a lot on the table, right? While we did increase new customers, a record in the year, to be expected for November to be a record, you do not want your ROAS being this high. You actually want it to be around your break even. You want to be able to push your spend up as long as that spend is resulting in incremental net new customers. You want to push that to the limit, and pushing that to the limit will bring your ROAS down to the point of where that next dollar earned is negative, and negative enough against your profit to where it's bringing your total profit down, or even that incremental profit is break even. This is where there's a sensitivity analysis that needs to be done to understand exactly where you want to land. But in general, this is so far beyond that we know, just in these numbers, without even looking in the media platforms themselves, that this could have been scaled more. We should have pushed a lot more advertising spend here, which would have resulted in a lot more a much greater amount of new customers. So our CAC would have went up, our blended ROAS would have went down, but probably could have kept them, in very good order relative to our kind of benchmarks here. But maybe we left 1,000 customers on the table, right? And what's 1,000 customers worth to your business over not just 12 months, but 12, 24, 36 months, right? You start to do the math on 1,000 customers times your lifetime value, and what that could have meant for your business the following year when you hit a down month, a non-holiday month, a down period, and where you're getting a lot of your revenue from your database. Now you have 1,000 less customers to get repeat purchasers from. And even if on those additional 1,000 customers, they weren't profitable in that period, they'll become profitable the next time they purchase from you in whatever your repeat purchase timeframe is, whether that's a month or 12 months down the road. Now, again, each business is unique, depends on your cash flow, how aggressive you want to be. But in general, that would be the story here. And that's why we really caution against using any one metric, especially a sub-marketing metric, which these are that, and paying too close attention to one metric without looking at the bigger picture of the business. This needs to be looked at how a CFO would look at it. Where are my metrics all up? What are my efficiency metrics? And how am I able to grow the business overall, even if that requires more investment. Am I incrementally growing the top line revenue while being at a place that I'm comfortable with from a profitability standpoint? All right, we've covered it. My hope is for anyone out there that is looking at a Shopify dashboard, kind of the default overview, and seeing, hey, is revenue good? Is profit good? That you're able to take away from this, hey, I really need to understand what my core e-commerce metrics are that are not listed on my P&L, but are just as important as everything in my P&L, if not more important, and start to build that out. You can use this template here. You can customize it to your business, but this is absolutely a great starting point. There's no reason why you shouldn't be able to collect these numbers in relative short order, especially if you have a marketing team behind you. And even if you don't, you can start to put together some of these metrics. So if you have questions, obviously we can help you with this. And this is a kind of standard operating procedure for us at Human with our customers. All right, good luck.